Hello, Baker Investment students. This is our final week. I want to say that I really enjoyed working with our cohort over this past 6 weeks into the seventh week. So we've got to experience a lot of things during this short class. We Chiefs won the Super Bowl. It was a great thing for Kansas City. We also saw some record returns in the stock markets. We'll see if this continues into the rest of the year. Of course, November elections could throw a wrench in that and really change perspectives in markets depending on how people interpret the economic policies of the candidate who would eventually win. So, and of course, the coronavirus at the same time too. So, hopefully we have that controlled. But we do know that's going to impact regional economies, especially in Asia and other areas, and it's definitely impacted the demand for oil. It's nice because when we go to the pumps, gas is relatively cheap here in the Midwest. So that's helped give us more disposable income to spend on other goods and services. So we'll just make sure to wrap up everything for week 6. Week 7 should be pretty light, actually. You're just going to have the homework problems from chapters 14 to 15 and the exam. I should have it out there about Wednesday. The exam will not cover the last 2 chapters. Always kind of have that philosophy. I want to make sure to have opportunity for you to kind of do the homework and get feedback on it first. So this exam will be a little bit shorter and just probably all multiple choice. So you'll just do the same thing again. Either just highlight the exam, copy the exam, put it in PDF, upload your answers, or you can put it on a Word document, just your responses like 1C, 2C, 3C, etc. So, all right, so getting to this week's material, we look at derivatives. So derivatives derive their value from some other underlying asset, whether it's a stock, a commodity, a foreign currency, and futures and options are the two that we look at primarily in these 2 chapters. The first one being the options in chapter 14 and in chapter 15 with the futures. I also put out Khan Academies out there. That's just a supplement. You don't have to view it, but I think he does a pretty good job explaining in detail how these derivatives work. But definitely the textbook has plenty of examples too. So the way I like to approach this and kind of explain this to students, that derivatives are good for hedging purposes, especially for investors. Now this course is about personal investing or investing from a corporation perspective. So we want to try to protect things. But in business, there's investments in the sense that, if I'm a farmer and I'm growing corn and I don't know what the price of corn is going to be 6 months from now, and I'm worried the price is going to drop, I can take out an options or a futures contract. So you see there the farmer has an underlying asset that he's trying to protect, some type of investment. If you're speculating, you're just simply betting on which way the price is going to go. But there are speculators that exist in markets, and these things, having the speculators there are important because it provides liquidity in those markets. And of course, the speculators are only going to take positions in which they feel they have a chance to make a profit on those positions. So, but a lot of this evolved in the 1970s, the Chicago Board of Trade, Chicago Mercantile Exchange. Commodities were always there, but then the financial derivatives started coming out about the 70s, and those kept rolling out to different types of derivatives. So, but getting back to that farmer example, I want you to think of it this way: like if the farmer has 5,000 bushels of corn, probably more than that, but he's worried about the price dropping 6 months from now. Well, if he does nothing, he goes to the market 6 months from now, and if the price drops, he's faced with that price, and that's the total revenue he's going to get. And but if he doesn't do anything, the price goes up, he benefits. So there's a risk there. So what he can do is he can use an option. Think of that as kind of as an insurance contract that says, hey, I'm willing to sell you you can go out and hit a strike price for a bushel of corn. Let's see if I look at an example here. Let's just say a bushel of corn is at the right to sell it at $5. And maybe currently in the market it's trading at $5.50. So the underwriter of that option, and of course the farmer is going to buy a call option, a put option. Put means the right to sell, call means the right to buy. So the farmer is going to buy put options, the right to sell his bushels of wheat. If 6 months from now the price is still at $6, he's not going to exercise that option. He doesn't want to exercise something at a lower price. So the person that wrote those puts, they get to pocket that money, but the farmer had a sense of security that he knew that he was not going to get less at a certain price. The other thing that a farmer could do is he could engage in a futures market. And a futures market, you're basically you're going long, you're betting that the price is going up, or you're going short, you're betting the price is going to go down. So you're taking a long position, you're anticipating the price is going to go up, short it's going to go drop. So the farmer's concerned about it's going to drop. So let's say that 6 months from now, the farmer is worried about the price of corn going down. He can take out a futures position that says, I'm going to bet that the price of corn is going to go down in 6 months. So in 6 months from now, let's say that the price of corn actually went up. So he's going to lose on that margin account. They have a margin account, and he's going to lose on that futures contract, but he's going to make up for it for the revenue in the higher price of the corn. So it's just offsetting, just trying to protect an investment. So those are ways that primarily options and futures are used to try to protect investments. And again, this could be for a corporation that's going to get euros from agreement on a contract. 6 months from now, they're worrying about, in that case, the euro depreciates in value. So I can take an option or a futures contract to protect myself. Now, think about these, you'll notice in the readings, especially with the futures, they do the opposite transaction. So what that means is they close it out. So you're going long, you're going to do it opposite, do short, and close out the contract. You don't want 50,000 cattle have that responsibility of having that delivered to someone. That's actually like a forward, an actual agreement that you're going to deliver that commodity. But 99% of that is all, it's just really imaginary if you think about it. It's, like even if you're trading oranges, there's not a physical, tangible orange there. It's just the idea, and you're just speculating on which way these prices are going to go. But these prices in the markets, the spot price, changes daily. And these are all impacted by shifts in supply and demand, and that can influence the prices. So, all right, some of the things I want to make sure to cover with these, I talked about the options primarily being a way to protect, but in the futures market, if you engage in this, you have to create a margin account, and if it moves out of your favor, then you're going to have to add more money to that. That's what they call a margin call. But they're always priced what's called mark to market. That is, whatever the price is today of, let's say, oranges. If it goes out of your favor, they're going to adjust your account. You're going to have to eventually, at some point, if it reaches that minimal reserve requirement, you're going to have to add more to it. So, other thing I want to mention too is with the bonds. Going back, let's think about our bond chapter, because you have a homework problem kind of tied to that, and it's called, with the interest rates, you're betting that the interest rates go up. Remember again that I can hedge on interest rates if I'm worried about them, but bond prices have that inverse relationship. So as bond prices go up, interest rates go down, or as interest rates go up, bond prices go down. So if you were betting that if you think interest rates are going to go low, you can take out a position on, say, U.S. Treasuries or bonds that you think the price is going to go up. And if you're correct, that can protect you against interest rates, or can protect you against the price of the bonds. And a lot of, especially mutual fund managers, other managers of large financial firms, may use derivatives to try to protect their portfolios, or you can use them too on an individual basis. So you're getting close to retirement. The S&P and the Dow have done quite well. You're months away from retirement, and you're worried about a big crash coming down, where you could take a position that I want to protect myself through an options contract, through a market, or a futures contract. That gets a little bit riskier, but you could also, it's just I don't want to take out of that position yet, but I want to buy some insurance to help protect me. The opposite would just be you just rearrange your portfolio and go to something that's a little bit more liquid and also doesn't give you quite the rate of return, but it's kind of a way that, hey, I want to protect in case the market keeps going up, but I don't want to get caught that I start to lose everything. And that's what happened in 2008. A lot of people lost half their retirement portfolios just because the market crashed so quickly, and some had to wait, or they had to live with less. So, All right, well, email me any questions you have about the homework, anything like this week. But again, we'll say I've enjoyed working with you all. This will be the last video mini lecture. But hopefully you've got a better appreciation of the investment markets, giving you some thoughts about your strategies. And I think when I started this course, I kind of mentioned about, really in life, it's about your choice to consume, your choice for work, and your choice for leisure, and you're trying to balance that all out. And modern portfolio theory throughout your entire life. So you don't want these big swings, but again, you have to ask yourself the question: why am I investing? What is my end goal? Is it to get to retirement more quickly? Is it to save for college? Is it to buy a new house? And what is my risk tolerance? Am I able to take big losses and I'm okay with that? If you're not, you probably want to be more conservative. So other than that, thank you and have a great week.